Hey Julie, I just wanted to say thank you again for sitting down with me. With everything happening yesterday with a new rate increase, I thought it might be a good opportunity to get some more information from you and see what your thoughts are about everything.
Yeah, absolutely. Yes, Bank of Canada met yesterday. It was their 7th meeting of the year, the 8th meeting coming up in December. And they surprised us yesterday. I think everyone was on track expecting a 75 basis point increase, and instead they increased by 50 basis point, which means that their overnight rate moved from 3.25 to 3.75.
Okay.
The overnight rate being the key tool, the primary tool they use to control inflation. And in turn, what happened is the prime rate, which banks and lenders use on some of their loan products that are variable, prime rate moved from 5.45 to 5.95. And it did surprise us.
Mm-hmm.
And obviously it's had some impact on some of our mortgage holders. What I should say before we move on to discuss the impact that it has had on our variable rate mortgage holders, Bank of Canada did indicate that yes, they've slowed the increases, but not necessarily stopping them.
Yes, I did hear that.
Yeah. So for those clients that have got a fixed rate, they don't need to worry. Their payments will remain the same for the remainder of the term. It's really our variable rate clients that things are going to change.
And that's where I think most of my clients are having questions about the
variable
rates. Yes.
Yeah. So not everyone would know, but there are 2 different types of variable rate mortgages.
Mm-hmm.
One is what we call an adjustable rate mortgage. And so for those mortgage holders with this increase, their payments will go up. And you know, we've run a calculation for those clients. It's about $30 a month per 100,000.
Okay.
And so a good example would be a mortgage of 500,000. That's now going to go up about $150 per month.
Per month. Okay.
So not too bad, but
yeah.
with the
good.
Accumulative changes,
Right.
You know, the payments have increased every couple of months over a month.
Well, it's good that you're explaining that, though. You know, puts it in perspective.
Mm-hmm. And so,
what about the other type of variable mortgage?
Yeah, so the second type of variable rate mortgage is a non-adjustable variable rate mortgage. And so what happens with these clients is their payments won't change when prime rate changes. Instead, what's going to change is the distribution of principal and interest within the payment.
Yeah.
So for these clients with this change, what's going to happen is more of their money is going to be going towards interest and less money going towards principal with this change.
Yes. So Julie, what are the options for my clients that have concerns about their payments going towards like the interest rather than the principal?
Yeah, great question, Kathy. And there are a few options for customers to take a look at. First of all, the first one that I would recommend is taking a look at their monthly payment and if they can make some increases to the monthly payment. And what that will do is it'll help redirect some money back towards the principal and less towards interest.
Okay.
And their mortgage specialist or mortgage agent or broker can help them out with that and look at some of the options compared to the increases that have happened over this year. The other thing that they could do is take advantage of a prepayment on their mortgage. The great thing about taking advantage of a prepayment option, which is a lump sum payment onto their mortgage, it will apply directly towards principal and may allow them to keep their monthly payments where they are so that they don't have to adjust their monthly budget.
That would be good, I think.
Yeah. The other thing too, they can talk to their mortgage agent or financial advisor to see if there's any options to convert into a fixed rate, see if that makes sense for them. Just keeping in mind that when you do lock in your mortgage or convert to a fixed rate, you are looking at fixed rates at this point in time, not your variable rate and not fixed rates previously this year. You would be looking into current fixed rates.
Yeah, good point.
They do tend to be a little higher, fixed rates, and so they really should be speaking to their mortgage agent or financial advisor to ensure that they're getting the best possible advice. And then finally, what they could do is look to see if there's any opportunity to extend out their amortization, which again would help bring back some balance with their payment towards principal and interest. Above all, it's super important that they are speaking to a mortgage advisor, whether that's a mortgage agent, broker, specialist, or financial advisor, to ensure that they're getting sound advice and making the right decision that works for them and their family.
I really agree with that. Thank you. Okay, Julie, so something else we're hearing a lot about are trigger rates, and I'm just wondering if you can explain that, because I know there's a lot to that.
Yeah, there's actually two triggers. There's a trigger rate and a trigger point. And the trigger rate and the trigger point both apply to the mortgage that we just discussed, the non-adjustable variable rate mortgage.
Okay.
So again, just to reiterate, the mortgage that the payment does not change when prime rate changes.
Okay.
What changes is the distribution of principal and interest. So when you hit your trigger rate, what has actually happened is you no longer have any money going towards principal, and all of your money in your monthly payment or biweekly payment is going towards interest.
Okay.
So in other words, you're actually starting to add to your mortgage because you're not paying any of the principal off, and you start accruing and your mortgage actually begins to grow. So to put it simply, if you reach your trigger rate, you've stopped paying off your mortgage.
So Julie, what happens if they actually do reach their trigger rate?
Okay, so normally what happens is the lender or the bank will let them know that they're getting close to, or that they've reached their trigger rate. And normally speaking, what they'll do is provide them with some options to ensure that what they don't do is move from reaching their trigger rate to the second trigger we talked about earlier, which is the trigger point.
Okay.
And customers, if they have reached the trigger rate, actually don't necessarily need to do anything. They can leave their payment as is. However, at one point they will reach the trigger point, the second trigger that we were discussing.
Yeah.
And what that means is for a conventional mortgage, if you think back to what I said earlier, that you begin to grow your mortgage as opposed to paying off your mortgage. So if your mortgage, for a conventional mortgage, if it exceeds 80% of the value of the property, or for a high ratio mortgage, if it exceeds more than 100% of the value of the property, then the bank is going to require you to make a change. And when I say the bank is going to require you to take action, they are going to need you to either make a change to your payment, make a lump sum payment to the principal amount of the mortgage, or convert it to a fixed rate option.
Oh, wow, okay. That's good to know. So one final question for you, Julie. I know that I get a lot of questions about, and that is, should I stick with the variable rate or go with the fixed rate at this point?
Yeah, no, great question. It's a question that we get asked multiple times each day. And really, there's not one answer that fits all situations.
Right. It's
very individual to the mortgage holders and their families. And so what I do is I tend to run through some different situations or things I want the customers to consider. The first being, are they thinking of buying or selling anytime soon? Are they thinking of downsizing, or maybe moving to that next property because the family's growing?
Yeah.
And if that is something that they're considering, is that in the short term? Is that in the long term? Will they be selling and then waiting a bit and then buying, in the coming months or years? The other thing too is there a possibility that they, might be coming into an inheritance and paying off the mortgage within a short period of time?
That's true, right? Yeah.
Or are they coming up for renewal? Or are they in a position where the mortgage is almost paid off? The other thing that I ask them to consider is payments have increased. How comfortable are they with those increases in the payments? Do they think that they can manage them for a little bit longer until rates start to stabilize or perhaps decrease in the future? Have they looked at their monthly budget? Is there maybe some other areas that they can look at to decrease their overall costs on a monthly basis? Do you really need a Crave subscription and a Netflix subscription? So are there some other areas that they can look at their overall expenses and reduce those to help them manage the payments? And as I mentioned earlier, there is most likely going to be another increase in December. And can they handle that increase. And so these are all things that we really need to look at and discuss to help them make the right decision for them. And so my strongest piece of advice is they really need to be meeting with a mortgage professional who can go over various options for them, look at different payments, and come up with a customized solution that best meets their needs and their family's needs.
I really agree with that. So this is the perfect timing actually to go through all that. So thank you. So Julie, before we finish up, I just want to see if there's anything else that you might want to tell our clients here that might be valuable.
Yeah, so one thing that I tend to share with my customers, and I hope it puts their mind at ease. Yes, there's lots of angst right now around raising interest rates, lots of information in the media, but I do ask them to reflect back on the changes that the federal government made in October 2016 when they introduced something called a stress test. And this stress test was introduced really to protect customers against rising rates because interest rates were so low. They introduced it so that we could ensure that what we were qualifying customers for, they would be comfortable with. And for the last few years, we have been qualifying customers at 5.25. So really the rates that we are experiencing right now, there should be some comfort that when we looked at the financial situation, when we were approving the customer, we were approving them at the rates that we're seeing right at the moment.
That's true, and so now it's come into play and it's helped out, right?
Yes,
so,
yeah, absolutely.
Okay. So thanks again, Julie, for meeting with me. I always find our talks so informative and useful for my clients and for myself too. I always learn something. So if anybody has any further questions, please reach out to Julie or Amanda or myself or anybody on our Linda Maguire team for more information.
Awesome. Thanks, Kathy. We appreciate the opportunity.
All right. Thank you.